Caroline Hyde. This is the best of Bloomberg Technology, where we bring you all our top interviews from this week in tech. Coming up, Snap, the big picture. We'll get you up to speed on the trading day debut as tech ushers in its first IPO of the year. Plus, Kalanick gets his close-up and it's not a good look. How the Uber CEO was caught on tape in a video handed over to Bloomberg. And we head to Barcelona in the annual Mobile World Congress. What the new FCC head, Ajit Pai, has to say about net neutrality changes ahead. First, to our lead. Snap wrapped up its first day of trading Thursday on the New York Stock Exchange. Shares closed up 44% from its listing price, and it reached a high of just over $26 before closing at $24.48. The maker of the disappearing photo app ended a long tech IPO drought, so will its debut open the pipeline for other companies? We caught up with Bloomberg's IPO reporter Alex Barinka and Bloomberg technology reporter Sarah Fryer, who covers Snap.
It seems like the sweet spot. If you think about the range, a typical IPO, you'd like to see 20 to 30%. Mm-hmm. This one was going to have a bit more buzz baked in. If you look at Twitter, it was, 70+% on day one. Facebook with the glitch was less than 1%. So somewhere in between seems like they kind of hit the sweet spot there. And when I look at trading and how the stock kind of flittered around that $25 mark all day, it was fairly stable. There wasn't a lot of swinging going on. We saw it sell off toward the end of the day there, down to its closing price of $24.48. But it seemed like a decent way to go out in your debut here. No one's quite complaining about the returns for investors.
I mean, looking at this IPO scoreboard, you look at Facebook, up now almost triple its initial IPO value, but after a year was down 31%. But Twitter, you mentioned it, on its debut opened up more than 73%, but look, after a year it was down 10%, now down 65%. So it's worth remembering that whatever happens on the first day of IPO doesn't always remain. Sarah, talk us through the managing of expectations and indeed perhaps where the roadshow wasn't all smooth. There were some bumps they had to iron over, many questioning the user growth.
Absolutely. So this is a company that is trying as hard as it can to not set up those comparisons to the companies you just compared it to, Facebook and Twitter. This is a company that doesn't want to be judged on its user growth, but it's going to be judged on its user growth because that's a metric that slowed in the fourth quarter. And if you don't have the users, you can't make the money off the ads. But Snap's argument is that the user engagement on its app is just so immersive and so frequent that it kind of doesn't matter the quantity so much as the quality.
Yeah, we're 18 times being logged into the app, I think, a day. I mean, that's pretty amazing statistics. Alex, you and I were down on the New York Stock Exchange. It was a buzz, a frenzy. Goldman Sachs had their role cut out for them. They were being stabilization for the entire trade. And they took their time over it, didn't they?
They did. They did take their time, and that's kind of what they're known for. And what I can tell you now is that you saw Bobby and Evan ring the bell. We were both there for that. I disappeared a little bit, chasing them down, because they actually went over to Goldman to watch the first trade happen. So the execs had to get there. They had to kind of work through that. And the shares finally started trading at, $11.19. So you can see that gap between the 9:30 open there. And it was so important for them to find this sweet spot where they thought that the shares would trade at to get this nice pop. Yeah. You saw them price at $17 a share, even though our sources say the deal was 10 times oversubscribed. So there is some kind of read-through that they maybe could have priced it a little higher. But if you think about the company's impetus for pricing it at 17 instead of making, let's say, $200 million more at $18 a share, doing that kind of rewards the shareholders who are willing to take a bet on them at the listing day and say, look, we'll give you a little bit extra wiggle room for your returns. And even though we're not taking so much money off the table, it's $200 million. So, we can kind of ease our way through that in trading going forward.
Sarah, you're out there in Silicon Valley. The quick question, and so much hope was riding on the success of this particular IPO and how it trades in the next few days, weeks, months, years, is because there's plenty of other companies sat there waiting to enter the public market. How do you think it's been digested in Silicon Valley by the investor base and by other startups?
This was a very high-stakes IPO because, as you said, there are so many private companies that have ballooned in valuations into the billions and, in some cases, tens of billions, like companies like Uber. And people have just been waiting for these companies to go public, but it hasn't been necessary because there's so much capital available to them on the private market. And also the markets were a little bit volatile. So they're looking at this Snap IPO. This is a big company, really the biggest social media IPO since Twitter. And they're saying, hey, if they can do it, that shows that there's an appetite on the market for these kinds of deals and maybe for highly valued stock.
I mean, Alex, you're talking to sources already. What are they saying? Are they sort of lining up who they should be talking to next?
Basically, yes. And so to Sarah's point, the average company, private company, is now staying private for 9 years. Snap is younger than that, which kind of used to be the MO for companies going public, right? They would go public when they were less mature. That hasn't been the case these days. Snap is kind of going against the grain by going out as early as it was. And, you know, there's been these arguments in the past year where the buy side in equity markets has been very risk off. So they want to see more profitability. They want to see more stability. But Snap is here coming out with an unprofitable company whose business model is only, you know, probably about 6 quarters old. And the deal itself did well. Again, still question marks about the long-term returns, where the stock goes, how the company fares. But this is a bit of a proof point saying, look, maybe staying private forever is not necessarily the best thing. Maybe having your judgment day out in the public markets is just as good as doing it privately with basically the same investors, these big crossover names.
Uber, Airbnb, hint, hint, nudge, nudge, wink, wink. Last one for you, Sarah, because you also cover Facebook, and the question marks that Alex was spelling out there, one of them is, well, can Facebook just copy what they do and do it better, and they've got bigger user base?
Absolutely, they can, and they have. Instagram in August copied one of Snap's most popular features, its Stories feature, where people can create daily reality TV shows of their life. This is a product that people are now using on Instagram now almost as much as they use it on Snapchat, or maybe even more by this point. And this is going to continue to happen. Facebook's app WhatsApp, a very popular chat app, more than 1 billion users around the world, had a similar feature added earlier this year. Facebook is considering doing it too. So this is just a constant drumbeat of copying of Snap's way of doing things. And yes, it does harm. It harms the potential. We'll never know how much faster they could have grown if it weren't for that. Now, the company doesn't attribute their loss of growth to Instagram, but it certainly is interesting. But one positive side of that I do want to point out is that advertisers say, it's a little counterintuitive, advertisers say that they actually can now justify buying Snap's ads because the format is now the same as ads they can buy on Instagram.
Bloomberg's Alex Barinka and Sarah Fryer there. Still ahead, we'll stay on the story of the week and catch up with one of the very first investors in Snap, Jeremy Liu, partner at Lightspeed Venture Partners. And New York Stock Exchange President Tom Farley discussed Snap's trading debut. Take a listen. This is Bloomberg.
I take great comfort that the stock opened at 24 and it's trading smoothly right around that number. That's exactly what you want on the first day, especially of a large IPO.
Now, back to the tech story of the week. Snap started strong in its first day of trading, opening 44% higher than the $17 initial public offering price. A number of Silicon Valley venture capital firms will make a small fortune from their investments, especially Lightspeed Venture Partners, one of the largest outside investors in Snap. The firm is now set to reap more than $1 billion from what began as a mere $485,000 investment. Now, we caught up with the very first investor in the company, Lightspeed Venture Partner Jeremy Liu, and asked, well, what made Snap such an attractive investment? Take a listen.
Well, you know, when we met Evan and Bobby and we heard about their vision, they talked about how there was something missing from social media, how it had become almost like a highlight reel for your life, where it was creating this sort of performance anxiety for people. Unless they were looking pretty or perfect, they weren't putting themselves on social media. And that meant that instead of people being able to see the full 360 degrees of people's lives, they were just getting this tiny little sliver. And what Snapchat did by making delete a default was to bring back the spontaneity and emotion and authenticity of communication that people have always had with their close friends.
I mean, it was quite amazing. You then committed to 2 subsequent rounds, more than $8 million. What did you see in terms of the growth? What potential that now the market is questioning? do you still see in terms of the growth trajectory?
Well, you know, when we first met the company, they had less than 100,000 daily active users. And most recently, it's up to 158 million daily active users. So it's certainly grown a great deal. But what we saw at the time was this amazing engagement. People were using the app many days a week and many times a day. And that's just continued to be the case. So today, people are opening the app 18 times a day. And when you see that, it's become a daily habit for people. And when you can become a habit like that, you can build really interesting and powerful companies.
But many are now feeling that the growth has fallen below 50% in the last quarter of last year. Is that something that you think will re-accelerate, or does it not need to?
You know, I think when you become part of popular culture and when you see that user base aging up, so it started off with mostly young women when we invested, mostly teenage women, teenage girls, I suppose. But today you see that that is being spreading to you know, people in their 20s and in their 30s and even beyond. And as you see that broadening, you can gain a lot of confidence.
What about geographically speaking? Because they've committed to the developed world only. They say you need high-speed, powerful phones. Where else other than the United States? We're almost hitting saturation point when you look at the US. Do you think there's more room to grow within the United States, but where also geographically?
If you think about the places that have high-speed internet connections today, it's the US, North America, which has about, I think it's about 70 million of the daily active users. Europe is also very big. And then rest of the world encompasses some of the parts of Asia that have more developed, you know, telecom, parts of the Middle East, and some other areas as well.
Do they need to expand past just Gen X, millennial? Do they need to lure the parents of Snapchatters?
Well, you know, if you take a look at Norway, it was interesting. Back in, I think it was probably the fall of 2012, Snapchat hit the top 3 in the App Store for Norway, and that was the one place that it got big faster than the US. And there you see it being used by people all across the spectrum in terms of age and gender, and it's really become embedded in the society. And so that gives you confidence that there's existence proof that this can be something that becomes used broadly by everybody.
And what about hardware? How much does that become an important factor to the business?
Well, spectacles are fun. I was actually just wearing them this weekend. I went skiing with my kids, and it was just the perfect way to be in the moment and to capture some of those memories without having it being intermediated with a phone between you and the experience that you're having. And so it's been a terrific experience.
I mean, Jeremy, I have to ask you, because there's been a lot of reporting about your own relationship with Evan Spiegel and Bobby Murphy. How is your relationship now with the business? Because it's felt that potentially some of the lack of shareholder control of Snap since it listed was in part because of some arduous, onerous points of view that you put on as a seed investor. Do you agree with that coverage?
You know, over the course of 5 years, there's going to be some points of friction in any relationship. And what's more important than that is whether or not you can work through it amicably and find a common solution that everyone feels good about, so you can work towards a common goal. And we did that with Snapchat, and I think today, while the IPO is certainly not the end goal, it's an important milestone for the company and one that I think is worth celebrating.
Do you think that the restrictions you put in place as a seed investor were onerous, or is it just what comes as part of being an investor when you're a venture capitalist and going into these very young companies?
When we first met the company, we were really clear with them that we were very interested in what they were doing, and we would love to continue to invest in the company in the future. And that's what we've been able to do.
That was Lightspeed Venture Partners' Jeremy Liu. Now to another big tech story this week. Uber, now facing battles on many fronts. This week started off with the Senior Vice President of Engineering, Amit Singhal, resigning after the ride-hailing company learned of a sexual harassment allegation from his previous job at Google. He has denied the allegations. Then, on Tuesday, Bloomberg obtained a video of Uber CEO Travis Kalanick boasting about the company's tough culture before berating a long-term driver who asked him about falling fares.
You know what?
What?
Some people don't like to take responsibility for their
They
blame everything in
But why
their
you
life on
sending the
somebody
email
else.
for town card?
Good luck.
Kalanick issued an apology in an email to staff saying, "To say that I'm ashamed is an extreme understatement. My job as your leader is to lead, and that starts with behaving in a way that makes us all proud. It's clear this video is a reflection of me, and the criticism we've received is a stark reminder that I must fundamentally change as a leader and grow up. This is the first time I've been willing to admit that I need leadership help, and I intend to get it." Now, it's the latest in a series of embarrassing incidents for the ride-hailing giant. Bloomberg's Brad Stone and Selena Wang caught up with Ryan Sava, Redpoint Ventures partner, to discuss.
Uber's corporate culture has been in the news lately ever since Susan Fowler, a former engineer, wrote a pretty scathing blog post about her experience at the company. Then we received basically a dash cam video from a longtime Uber driver who's unhappy about the direction that pay for drivers has been going. He sent that to us, and have a listen. So in this conversation, which takes place on Super Bowl Sunday, Travis is actually talking to some friends about the culture at Uber and how the company is doing. Have a listen.
My year is coming up, maybe 40.
I make sure every year is
It's Christmas break. Saturday, by the way.
So Ryan, you've had to counsel many a CEO and a founder through through these unflattering moments. What do you tell them when they're in the kind of vortex of bad news like Uber is right now?
Yeah, I mean, I think it's true for any company. Like any crisis that happens, it's about truth seeking. How do you try and get to the root of what's going on and know that most of the infrastructure in the company around you is there to try and hold bad information away from you? So you have to be actively and aggressively looking for that truth and then try and figure out how to solve it quickly and communicate as clearly as possible.
Well, I can't say, we thought a lot about, whether to write this story, but it seemed to me that, Travis's personality is really kind of central to all these questions. This is a company that has changed how cities work, and he's not only talking about the culture of Uber, but really kind of showing a little bit of his pugnaciousness, right, his personality. So have a listen to this second clip where the driver challenges Travis Kalanick about the issues around driver pay, and he responds somewhat forcefully. Have a listen.
You know what? What? Some people don't like to take responsibility for their They blame everything in their life on somebody else. Email for town card. Good luck.
Brad, that was some pretty surprising stuff. What do you think this really reflects in terms of Uber's culture? Is there really a trickle-down effect? I mean, when you have a CEO that has said rather pugnacious things like that, what does that mean for the overall company?
This is why actually Uber has been successful because, Travis, he doesn't suffer fools. He has bowled over every regulatory and competitive challenge in his way. The issue is that he has to be a politician now, right? He has to deal with these very sensitive constituencies. And here's maybe an example of him not putting his best foot forward. And Ryan, I'm curious to hear what you think. I mean, you're friends with some of these folks on the Uber management team, and you've known Travis for a long time. Do these CEOs and founders now have a responsibility to be a little less pugnacious and more politically astute?
Yeah, I think any company that ascends in the way they have and other companies have, there's a point where you're fighting as an outsider for a long time, and suddenly you're someone everyone else looks at, and there's a transition that happens, and you see some leaders make it and some don't. And I think they're going through that transition now. I mean, watching this, I'm curious to see and think through, you guys get something like this dropped on your doorstep. How do you think about the process of assessing that and whether you publish it or not? Uber's a utility now. It's changed, the way these cities operate, and Travis's personality and Uber's culture is so very much in the news right now. So it seemed to me that when we got this video, that we really didn't have any choice. It's very much topical, and it is another one of these unscripted glimpses about the man and about the company.
Still ahead, we head to Barcelona and bring you our interview with the Federal Communication Commission's new chairman, Ajit Pai. This is Bloomberg. Now to Barcelona, where we reported live this week from the annual Mobile World Congress. And it wasn't just tech leaders in attendance, regulators were there too, including the Federal Communication Commission's new chairman, Ajit Pai. Now, we caught up with him and began by asking for an update on the AT&T Time Warner deal.
It's limited to these particular facts, and as I understand it, the parties have structured the transaction so that it won't come before us, and that's the reason why I said what I said yesterday.
So give us
that's what market light actually therefore is. So would we be right? The market already is expecting it. Russell 3000 TV radio index is up. Are we going to see more M&A in 2017? Will you allow that to go through?
That's a decision, obviously, for the private sector to make. My job is a very humble and, frankly, boring one, which is simply to review the papers that are put before me, take a look at the facts as presented, and make a decision based on the law and the precedents that are long established. And I can't opine in the abstract about any particular transaction.
We spoke with Tom Wheeler, of course, your predecessor at the FCC as chair, and he was very much of the view that 4 players in the mobile space in the United States was what was needed for a competitive market. But you say at the moment it is extremely competitive, but I wonder whether 3 players would be enough.
I can't say in the abstract what the optimal market structure is. What I do know is that the current wireless marketplace in the United States is extremely competitive. Recently, for example, after the FCC stopped its investigation of free data offerings, every single one, all 4 of the national wireless carriers in the United States announced unlimited data plans. That's a good thing for consumers. So in the context of any transaction, our focus is always going to be what's in the public interest. And if it is in the public interest, then we would be more favorably inclined to approve a deal.
If you were to see T-Mobile US team with Sprint, would that still allow for a competitive space?
So points for trying, but unfortunately I can't opine in the absence of particular papers that present the facts before me.
And already you've moved to roll back some of the privacy rules that are surrounding broadband at the moment. This, of course, being where customers would have to opt into certain internet service providers for them to use their data, and you're wanting to scrap that. The question is this going bigger? Are we going to see you completely roll back net neutrality? Would the Title II protection no longer be enforced?
Well, that decision simply meant putting a pause on one of the rules that was going to come into effect on March 2nd. More broadly speaking, I think there's a broad consensus about the need for a free and open internet. That's the internet we've had since the dawn of the internet age in the mid-1990s, and that's something I think consumers and companies alike have come to take for granted. The only question is, what regulatory framework can we adopt that both protects that core value and preserves a massive incentive to invest in infrastructure across the United States?
And speaking of regulation, well, Europe's top tech execs were making the case for less regulation on the continent. That was while at the Mobile World Congress. Tim Höttges is the CEO of Europe's biggest phone company by market value, Deutsche Telekom. And he called for an easement in the transition to a 5th generation of wireless services that would spur growth. Take a listen to our conversation.
For me, it's more important that, across the globe, for this global connected industries, we are connecting the people across the globe. We need the same standards in all our markets where we operate. It cannot be that we have 28 regulations here in Europe, that we have a US. I want to have a harmonized, a standardized one. The US is a very liberal market in its way, so it is much better to operate there. I think it's easier for the networks to get built. So I think the US model is a good model for the world.
What about M&A in Europe? Because Margaret Vestager has pushed back against some M&A that is happening across continents. How much is that a frustration? Do you feel that consolidation is needed in Europe more?
Look, in Europe you will find consumer prices which are significantly lower than in other markets in the world because of this huge competition which we have. In most of the markets we have 4 mobile operators. And if you're trying now to create, let's say, the power for building other networks and to build synergies in the network, we are not allowed to do so. So it's a quite difficult ecosystem, and I think if we would be enabled to consolidate more in the European market, there would be another reignition of investments for our industry.
Now coming up, Snap shares soared during its trading debut, but the company still has to address slower user growth. We'll dive into the metrics next. And if you like Bloomberg News, check us out on the radio. You can now listen on the Bloomberg Radio app, Bloomberg.com, and in the US on Sirius XM. This is Bloomberg. Welcome back to the best of Bloomberg technology. I'm Caroline Hyde. Now back into the top story of the week. Snap shares soared on its debut, closing up 44% from its listing price. Yet the company still has some things to prove. One big concern for investors is slowing user growth. On Snap's IPO roadshow, the company told investors much of this problem was due to an issue with its Android product. But some were sceptical of that answer. We dove into it all with Bloomberg editor-at-large Corey Johnson and Jitendra Warrell of Bloomberg Intelligence.
I mean, fundamentally, for this company, for this business to grow into the valuation it's at right now, it's going to have to be a better business. It's priced as if a lot of things are going to work, but when I looked, through the SEC filings, through the S1 statement, the amended S1 statements, one of the biggest issues was this rapid decline in user growth, and we've discussed it a little bit. But they've certainly acquired a lot of users, and these are rabid users, and they like to talk about the engagement, how much time users spend on the service, perhaps in part because the size of the user base isn't actually huge yet, right? It's half of Twitter's, it's a fraction of what Facebook's looking at. But maybe more importantly, the growth has slowed down dramatically. They added only 5 million users in the fourth quarter of last year. And even the quarter before, the user growth was also quite slow compared with historical numbers. In fact, going into the few quarters before that, there was an acceleration in growth rate. Yeah. Then the growth rate fell off dramatically. And that happens, it coincides exactly with the launch of Instagram stories. And that to me is the most disconcerting thing. The suggestion out there is, despite the really cool filters and other things that Snapchat has unique to Snapchat, Instagram's eating their lunch when it comes to doing this sort of storytelling on the mobile app. And you can see it, I think, in the user growth numbers.
Yeah, the copycat is a key concern. Looking at the Bloomberg, already deep diving into the analyst recommendations that we have on the Bloomberg for Snap, we have only three, but still, 2 of them are sell, 1 of them is a hold, not a single buy. And in fact, Pivotal Research saying this share could drop all the way down to $10. Jitendra, give us what the opportunities are for scale, though, because you've highlighted that, yes, analysts, we have seen the revenue perhaps grow, but perhaps the overall increase in user base slowing, but there is still potential for it to exceed its current form.
So if you actually look at their user growth issue, right, I mean, they're blaming it on the Android performance issues, but if you split it by geography, what you'll notice is the rest of the world, not Europe and not North America, is what showed the slowdown. So they just have to show over the next 2 quarters that they can be resilient, like in the face of increasing competition from Instagram, like Corey mentioned. If they whiff that numbers, I mean, there's a serious problem here.
Jitendra, do you think that what are the opportunities for growth, particularly outside of the age range? Gen X, millennials, people are now talking that parents are busy Snapchatting. Is that really the case? Will they look outside of the current age group?
I don't really think so, because this is a millennial-focused platform. If you look at their strategy overall over the last couple of years, it's been very millennial-focused, and they've shown that they get this audience better than most social networks that are out there. So I think sticking to their strengths is a good thing. Having said that, if you look at last couple of months, you'll see an uptick in 35+ audience based on what Comscore data is showing. That's interesting. So maybe bringing in celebrities and followers that they have onto the platform to get some of this peripheral user base on could be one of the strategies.
I mean, they're already celebrities in their own way, Corey. We're looking at a picture of the social media age demographic breakdown. What's interesting is potentially they were already hitting saturation point when it comes to the United States. Others saying, look at the rest of the developed world for them to expand. They have been looking at their international reach.
Yeah, so internationally the company's been growing, but growing at considerable expense. It appears that the service either has become suddenly expensive to provide for U.S. users, or the international users just cost a lot more for them to provide for. So while that international growth might offer some opportunity for them, it's also coming at a great expense. This is a business that has had negative gross margins for every quarter of its existence except for the last 6 months. And so on a trailing basis, you've got negative gross margins. As I mentioned earlier on Bloomberg Radio, there are 552 stocks out there with over $10 billion market cap. Only Snapchat and National Oilwell Varco have negative gross margins. That's just not a business. The very essence of any business, whether you're making oil wells or selling widgets or selling Snapchats, is you got to sell something for more than it costs. These guys are unable to do that.
And Jitendra, when we look at your Bloomberg Intelligence analysis, you have dug into looking at the market capitalization in terms of the ratio of the users that they have, the user base they have, and they say their market cap value per daily active user is significantly less than Facebook and Twitter was.
Yes, that's one way of looking at it, but actually if you look at the big picture and compared to all the IPOs, all the key IPOs that happened over the last decade, Snapchat's coming out right at the top of most of them. And with those outsized valuation comes outsized expectations. So revenue growth, I don't feel that should be a worry, to be honest, because they've just started monetizing it. But user growth, if they show any weakness, especially given Instagram's ramp, that would be bad news for the company.
Jitendra, it's interesting. We just had Sarah Fryer on saying that actually it's a bit like when Apple went into music streaming, Spotify's own business model was sort of vindicated to a certain extent. Do we think the fact that perhaps Facebook is doing everything they can to copy Snap because they couldn't buy it, does that actually vindicate it to advertisers that this is where you want to be, actually splashing your cash?
Yeah, see, that's why it's a wait-and-see story, right? Like, initially, you'll have the experimental budgets that advertisers spend on everybody but Google and Facebook distributed to Snapchat as well, and that's where their revenue growth initially will come from. But longer term, if they prove that they can hold the engagement among this core millennial group that they have, and they continue to make it easier for marketeers to advertise on their platform, then their revenue can scale. So it's really a show-me story at this point.
Bloomberg editor-at-large Corey Johnson and Jitendra Worrell of Bloomberg Intelligence there. And a quick update on Yahoo. This week, the company filed its 10K. That's an annual report required by the SEC, measuring a company's financial health. Now, a few highlights for you. Ronald Bell resigned as the company's general counsel. Also, CEO Marissa Mayer offered to forego her annual equity award and bonus, given that the 2014 security breach occurred during her tenure. Bloomberg News received a statement from Mayer stating, "I am the CEO of the company, and since this incident happened during my tenure, I have agreed to forego my annual bonus and my annual equity grant this year, and have expressed my desire that my bonus be redistributed to our company's hardworking employees who contributed so much to Yahoo's success in 2016. Now coming up, YouTube is taking on traditional cable companies. Our conversation with YouTube CEO Susan Wojcicki about the company's newly announced TV service next. And a reminder that all episodes of Bloomberg Technology are now live streaming on Twitter. Check us out at Bloomberg Tech TV weekdays at 5 p.m. in New York, 2 p.m. in San Francisco. This is Bloomberg. An update from Amazon after a massive internet outage in the US earlier this week. The company says human error at its cloud business caused those sweeping internet outages that lasted hours on Tuesday. It cites efforts to fix a billing system bug for the prolonged disruptions. Amazon says an employee accidentally switched off more servers than intended, causing errors that cascaded through the S3 service. The service is used to house data, manage apps, and software downloads by nearly 150,000 sites. Meanwhile, YouTube is going primetime, announcing a new service this week called YouTube TV. It will deliver an assortment of major TV channels to paying customers for $35 a month, starting this spring. Bloomberg's Lucas Shaw spoke with Susan Wojcicki, CEO of YouTube, at an event in Los Angeles. He started by asking her about the details of the new service.
Well, we see that on YouTube, we have a lot of demand for TV content. And we think it's a great opportunity with the mobile phones because everyone's carrying a TV around with them in their pocket, but they're just not using it for TV. So we saw this giant opportunity of how can we take all this amazing TV content and make it available to a generation that loves content, but they want their content on demand. They want to watch it on any device. They want to not have the commitments that are currently required for TV. And so we just saw a big opportunity to bring the full TV experience to our audience.
Now, with all these TV networks, these are owned by companies that in the past YouTube has had somewhat of a tortured relationship with, fighting over piracy, copyright, all sorts of things like that. Did you have to make any assurances about those topics, or how are they to deal with in these negotiations?
Yeah, well, we actually work with all of the large broadcasters and the networks to bring that content onto YouTube now. We have clips, we have shows, so we've had a good relationship with them, and I think they have seen the opportunity to use YouTube as a mechanism to get more promotion for their shows, to have time-shifted versions of their show on YouTube. And so this is really just taking it to the next level.
Right. Now, you've experimented already. I mean, most people think of YouTube as this big free this place where they can go and get video for free. You experimented with paid with YouTube Red, which you rolled out last year. What have you found about YouTube users' appetite for paying for something, and what is the future of YouTube Red now that you have this other full TV service?
Yeah. I mean, we think there's an opportunity for users to be able to also have a subscription service. And so while the free ad-supported model is a wonderful model, and we're investing in that, we see an opportunity with TV content to be able to offer that to our users for the $35 a month for the 6 accounts. And so that's a exciting opportunity to expand to a new type of content and to make that available to our users.
Yeah. Do you think this service then kind of helps boost the business of YouTube? Does it increase your chances of kind of generating serious profits? Does it help lift advertising revenues?
Well, I think what we see is that an opportunity to be able to offer TV content to our users in a way that they're used to consuming content. And so if you look at this generation of the cord nevers, at the cord cutters, at the millennials, they expect their content to be on demand. They expect it to be cross-platform. And so we just saw a really big opportunity to be able to bring this amazing TV content to this generation and connect them with content in a way that they expect to consume TV content.
Yeah. Do you think there's any TV content that's missing from it? You have some of the broadcast networks. You don't have some of the big cable networks from Turner or Discovery or Viacom. Is that something that'll change?
Well, it's a new service, and so it's certainly always evolving, but we feel really happy with what we have right now, and we think we offer a really great set of content that's available for a low price of $35 for 6 accounts.
Yeah. What do you think is the big differentiator between this and some of the other live services out there, like the ones that are coming from Hulu and DirecTV and Sling?
Well, we hope that the biggest differentiator is it's just a great experience. And so when our users use it, everything works in a way that they expect it. So everything works seamlessly cross-device, that we have an unlimited cloud DVR storage, so you can quickly and easily save everything, that you have no commitments when you sign up, and that you have great search. And so these are all things that we, as a technology company, have spent years developing, and now we're excited to bring this to TV.
Yeah, where do the normal YouTube creators that people spend so much time watching already on the service, where do they live within this TV service? Is it part of it, or are they separate from your regular cable network?
Yeah, so the YouTube creators, we're going to have some YouTube content as part of this service. The episodic content will also have the top trending on YouTube available. And so we're excited to bring those 2 parts of YouTube to this service. And then, of course, the original content that YouTube is creating as part of YouTube Red will be available on our YouTube TV product.
Will it be available for the $35 monthly price, or will you have to be a YouTube Red subscriber?
So the YouTube Red Originals will be available included for the $35 price for our YouTube TV product.
Right. And one thing that you've stressed in this service, and a lot of the new live services stresses sports, because that's something that you have highlights on YouTube, but you don't have the live sports. Do you see yourself bidding for sporting rights in addition to what is already available on YouTube?
Well, the goal of this product is to be able to offer TV content and have a great TV content experience, which includes a lot of live sports. And so via our partnerships with all of the broadcaster and networks, we have a really comprehensive sports offering for our users with this product.
YouTube CEO Susan Wojcicki speaking with Bloomberg's Lucas Shaw. Now, let's head back to Mobile World Congress in Barcelona. We heard from some of the biggest names out of European tech while there, including Ericsson. Ericsson is betting big on cloud technology. It's aiming to capture some of the $1.2 trillion market it expects fifth-generation mobile broadband services to spur. We caught up with Ericsson's Chief Executive Officer, Björn Ekholm, for more.
In order to be a successful company, I think you need to make money. So you need to have a bottom line. So that's why that is a hygiene factor, as I call it. But we of course need to invest to make sure that we stay ahead of the game. But it's really only by being profitable we will be able to invest for the future.
Do you think some of the pricing pressure is easing at the moment? The likes of Huawei no longer putting quite so much pressure now that they're a more established figure in the market?
Well, pricing pressure will always be a factor to deal with. We can only combat that in a way with innovation, new business model, new service offerings, etc. And that's what we will continue to do. We can't bet on the market changing.
There's much anticipation, shall we say, being written in analyst notes that maybe you'll start to restructure the services side of the business. Should that anticipation be there?
You know, I'm 5 weeks in, almost 6, starting my 6th week. So I think I'll need some more time, and then we will start to communicate what we do.
When you're communicating what you're doing, many have been focused on the credit rating of Ericsson at the moment. You look as though you're really prioritising the cash balance at the moment. You've been going out there, entering the bond market, curtailing your dividend. How important is it to keep that investment grade?
No, it is important for us. It's important for our standing, call it, with the capital markets and also with the industry. So we like to make sure we have the rating. And also having a strong balance sheet is important, again, more to invest for the future. We are doing really long-term investments and long-term bets. That can only be done if you have the financial stability.
Long-term investments and bets. I'm going to dig in a little bit more into the potentially partnerships, because there's been looking at some of your lower margin areas of the business. Is this a time that you could be working alongside and with other companies rather than standalone basis?
I think we will always work in partnerships with companies. You know, we have a partnership with Cisco, for example, but you will also see that we evolve our partnerships into new areas, like we're doing with Scania. We display a truck in here. So we will see, I think, in the new world, in the future world, it will be much more about ecosystems and partnerships and collaborations, and that's where we are going to be.
Still ahead, we get back to our main story of the week and Snap's first day of trading. Just how big of a paycheck are the co-founders bringing home after Thursday's pop in share price? We'll hear from the Bloomberg billionaire team. That's next. And this is Bloomberg. A stock we're watching, Apple hit an all-time high this week after BTIG published a bullish report on the iPhone maker. BTIG analyst Walter Piecyk joined Bloomberg Daybreak Americas. That was on Wednesday, and reiterated his buy rating and raised price target on Apple.
There's a lot of anticipation building up for this new phone in September. There's maybe a difference where we haven't had a substantial difference since the 6 and the 6S came out. So it seems like the multiple can continue to creep up a little bit more, and if you look at a year and you look at 2018 earnings with growth, if they can deliver mid-single-digit growth, you can get more run out of this stock.
And another stock on the move this week, of course, it was Snap. The company's public offering added over $1.5 billion to the founders' fortunes. Investor appetite for shares propelled Evan Spiegel and Bobby Murphy up more than 150 places on the Bloomberg Billionaire Index. Tom Metcalf of Bloomberg News joined us with more.
If you look back at the course of their fortunes, they were like nowhere in 2011, 2012. All of a sudden, 2014, you get this $10 billion valuation of Snap. And now I think it closed at like $28 billion today. So it's one of the all-time fantastic growth stories. It's just whether it's going to continue or not. And now perhaps their cash is a little bit more liquid. We'll see how much they start spending. How does this rank them in comparison to the rest of the big tech billionaires out there, 280, 281? They're definitely up there. So, you know, the classic names to compare with might be Jack Dorsey of Twitter. He's actually only got about 1.5 billion. He also, poor guy. Yeah, I know. You've got to feel sorry for him. He's got 2 jobs. He's also CEO of Square. And then along with the other sort of startup sort of unicorn head honchos, the 3 Airbnb co-founders are about 3.6, so they're ahead of them, and they're just behind Travis and Garrett Camp of Uber. But obviously they're way behind, say, the Jeff Bezoses, the Mark Zuckerbergs, and the Bill Gates, who are up in the 50, 70, $90 billion range.
Give us, not only, we were just looking at a screen there, talk us through it, because we want not just the founders that made a lot of money, but also those venture capitalists that made a big bet in the early days.
Yeah, exactly. So Benchmark, just today, they made about 900 million and they've got about a $2 billion position. And then Lightspeed Ventures, there's a great story about how kind of Evan Spiegel decided after dealing with Lightspeed Ventures that he'd make sure he had voting control of Snap, and they've got about $600 million gain this year.
Look at that, $613 million. What about the bounce that we tend to see on the first day? We know that it's up 44% today. Twitter was up 73% on its first day of trading. So these sorts of fortunes aren't always stable.
Yeah, exactly. It doesn't really sort of point towards what's going to be happening in the next year. You know, Twitter up, as you say, something like 70%. It's now off its IPO price, down about 30. Facebook was pretty flat on the first day of IPO, and now it's up, since its IPO, 260%.
Hence old Zuckerberg's wealth. How is Spiegel and Murphy's sort of fortunes changed in the founding of this company in particular? You were talking us through how it was like a rocket ship and the fact that it all sped up so quickly, but is this now the point that they actually cash out? How? Because a lot of it is going to be locked in for the foreseeable future for us.
Yeah, so they both sold about 16 million shares in the offering. So they've kind of taken home at the $17 price, $272 million. You get tax on that, but they're looking at a bank account of about $180 million. In terms of the Snap shares, yeah, there'll be restrictions on when they can actually start selling. And obviously they've got a huge position each in Snap. It's sort of about 20%, and so each. So if they started selling that, then you'd assume the value of their holding would drop down. But no one can feel sorry for them. They've done very well, and I'm sure they'll be celebrating in LA tonight.
Tom Metcalf of Bloomberg News there. And we've been bringing you interviews from Snap investors who were there from the very beginning. My colleague Scarlett Fu and Oliver Rennick spoke to Hemant Taneja, the General Catalyst Managing Director. He gave his thoughts on the company's performance in the first day of trading on Thursday.
I think the successful start that you're seeing is a reflection of really two things. One is how popular the product is and how well the company has executed over the last few years. And the second, frankly, also is that there haven't been a lot of tech IPOs, and there's a strong investor demand to invest in companies like Snap. It's great to see.
It's great to see, and if you look at how the stock is trading right now, $25 and change, around 26, and of course it IPO'd at 17. Where do you see it closing, and where do you see it trading in a quarter from now?
Well, I can't see the future. I mean, I think the things I can comment on, the company's done a good job setting expectations at the right levels. I think you're seeing the strong investor sentiment behind the company, and every decision they're making is for the long term. What happens sort of in the next few days is really hard for me to predict, but so far so good.
So far so good, and the reason I ask that, of course, is because you could go the way of Facebook, where you didn't have a great debut, but the stock has done very well despite a lousy first quarter, or Twitter, which did better, but then has fallen below its IPO price about a year and a half into its existence as a publicly traded company. What is your confidence that Evan Spiegel and Bobby Murphy can guide Snap to avoid going the way of Twitter?
Yeah. So I think this is the key question that everybody talks about here in Silicon Valley as well. And the reality is every one of these companies is very different from each other. Twitter is, it's still the 140-character metaphor for broadcast. It serves a very important function, but it's very different from what Snap does, which is sort of communication and for the everyday lives. I mean, there's hundreds of millions of people that use it multiple times, sort of 10 to 20 times a day. So what I would say is I look at sort of how Evan and Bobby, to your point, have executed over the last 6 years, and how many interesting products they've launched, and it's that's a testament to how different the company is from Twitter and even Facebook when they had gone public.
And that does it for this edition of the Best of Bloomberg Technology. We'll bring you all the latest in tech throughout the week to come, including our exclusive interview with the lead of Google's Cloud Machine Learning Group. That's Fei-Fei Li on Wednesday. Tune in each day at 5 p.m. New York, 2 p.m. San Francisco, and 6 a.m. in Hong Kong. Remember, all episodes of Bloomberg Technology are now live streaming on Twitter as well. Check us out at Bloomberg Tech TV weekdays. That's all for now. This is Bloomberg.